hundreds of thousands of baby boomers that own businesses looking to retire, looking to sell their businesses off, and they want the legacy of those businesses to carry on. And so I saw that there were so many businesses on the market, and then the market was so saturated that I wanted to get into the private equity game, raise some funds, and go after the silver tsunami, as we're calling it. So both of the funds, they pay out quarterly distributions. So with Legacy Capital, LPs can expect a 92% return on average per year. We're not a VC. We're not looking to acquire 25 companies and hope that one of them makes it. We're acquiring 25 very profitable companies that have been around for several years.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Scott Hauck with us. Scott is an operator turned investor and the founder of Legacy Capital and Hauck Capital. Scott is challenging the typical strip and flip model by focusing on what he calls the silver tsunami, a massive wave of legacy businesses from retiring owners. We'll discuss his white glove approach to preserving the soul of these companies while driving growth. But that's not all. We'll also hear the fascinating story of his accidental fund, Hauck Capital, and how it's positioned to capitalize on the UAE's massive $100 billion push into AI. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called PE10X, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. PE10X is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode. Hey Scott, so good to have you on the VC10X podcast. How are you doing?
Good. How are you? Thanks for having me.
Yeah, it's a pleasure, and I'm doing very well too. Thank you for asking. So, to start things off, can we first have your origin story and what experiences shaped your path into private equity?
Absolutely. Yeah, I've spent the last 20 plus years as an operational partner. I've worked on over 150 different businesses throughout that time. As as a operational partner, as clients, I've worked with lower mid market to enterprise level clients like uh, Panasonic, Verizon, Qualtrics. I've worked with Coca-Cola, Fitbit, all in the pursuit of helping these businesses with their operational and financial goals. I have been a part of 6 different exits. The most notable exit was the sale of Galileo to SoFi a few years ago for $1.2 billion. And essentially, I saw what was happening in the marketplace in the US with all of the legacy businesses that were hitting the market. So hundreds of thousands of baby boomers that own businesses looking to retire, looking to sell their businesses off, and they want the legacy of those businesses to carry on. And so I saw that there were so many businesses on the market, and that the market was so saturated that I wanted to get into the private equity game, raise some funds, and go after the silver tsunami, as we're calling it, with all of these legacy businesses that are going on the market at extremely undervalued rates, and they're extremely profitable. And so I launched Legacy Capital about 2 years ago to capitalize on that opportunity in the U.S. market, and and really to do what I've been doing the last 20 plus years for my own businesses, for myself. And later, I launched Hauck Capital in the fall of last year. It was kind of an accidental fund that we launched. It's based out of the UAE, and we launched that fund to really take advantage of the AI opportunities in the UAE right now. The UAE government has set aside $100 billion to invest in AI and emerging technologies over there. and we're looking to capture a large portion of that with our $500 million fund. So 20 years, 20 plus years as a operational partner, worked on a lot of different businesses, different sizes of businesses, different industries, and launched the funds over the last couple of years to really capitalize on market opportunities.
Right. That's quite interesting. And how do you plan to make it different or maybe challenge the traditional private equity model with legacy capital?
It's a great question. I mean, we're not the typical financial strip and flip private equity model. The businesses, especially on the legacy capital side, these businesses are owned by people that want to retire, and these businesses are their babies, and they protect them. They're very proud of what they've built, and we take a very empathetic approach to coming in and doing due diligence on these businesses. We work as operational partners. That's what I've been doing for the last 20 plus years. So we come in, we provide everybody in the business, including the management team that's looking to leave, with equity in the business. We're incentivizing everybody to help build these companies up. And we understand that these companies are their babies. And so we take, like I said, a white glove approach to handling them and to building them up, um, and looking at really supporting them from an operational standpoint, not just with, cramming unrealistic financial goals down their throats.
Absolutely. So at Legacy Capital, is there a specific niche that you're targeting of businesses that you want to acquire and build?
Yes, and so we're looking with Legacy Capital, we're primarily looking in the technology and transportation spaces. I know that's somewhat broad, but technology-wise, specifically, we're looking at SaaS companies. We're looking at e-commerce-based companies. We're looking at fintech and healthcare companies. On the transportation side, we're looking at freight companies, so standardized freight companies, 3PLs, and transportation technology companies.
Got it. Quite interesting. And why did you choose these themes specifically to target?
Uh, Really, it's where I have experience. So I've spent the last 20 plus years working in technology, transportation, healthcare, finance, and so I decided to focus on industries that have less governance and compliance overhead. And with funds, our second funds with Legacy and with Hawk Capital, we're probably going to be more industry agnostic. But for now, we're focused on industries that I have a lot of experience in, that my team has a lot of experience in, and has less compliance and governance needs.
Got it. Very interesting. And beyond the deal, what's the operational approach that you're taking at Legacy Capital? How do you plan to build those businesses after you acquire them before you try to exit?
That's a great question. With every one of the businesses that we're currently looking at acquiring, the management teams want to stay on from anywhere from 6 months to a year and a half, and even 2 years. So that helps us transition the businesses over from the existing management that wants to sell them over to a new management team that we can bring on and train. And on top of that, we look to start um, upgrading these businesses' processes and technology platforms day one. We transition them over to what we call our continuity platform, which is really a large tech platform where we essentially have an agency model where where we're able to come in and plug in these different businesses, their technology platforms or the ones that we upgrade for them into this platform, and we can start tracking everything that they do from a return on ad spend perspective to a return on investment perspective, and see where these businesses are, where they're spending money and making the most return off of their activities. So within about 120 days, we come in and we're optimizing these businesses from a platform and process perspective.
Quite interesting. And as the name suggests, legacy, right?
Yes.
So, how are you putting emphasis on the legacy of the business and working with the original founders of the business,
Yes.
maybe your promoters, to preserve that and make that continue forward?
Absolutely. Yeah, we understand that these businesses on the legacy side are their babies, and so they're not only helping with transition, we're providing them with equity in the new business to help incentivize them to help us transition everything over. But we understand that these businesses are important to them. They're important to the American economy, and we want the legacy of these businesses to live on.
Absolutely. And do you carry forward some principles that the founders say that, okay, these are the principles that I build this company with, build this business with, and I want these principles to live on? Is there some sort of sort of philosophical thing that also goes on there besides the operational approach?
Sometimes there is, and obviously we take that into account. It's got to be a good fit for the funds as well. The businesses we look at, they need to be adding value to the markets, and they need to add valuable, services and products for the next several years. There needs to be a lot of upside on top of the fact that they need to be very profitable. We only look at the top 5 to 10% of businesses that are on the market right now. But yeah, we take a look at, you take everything into account, and make sure that we're working with the existing managers in a very holistic fashion.
Got it. Interesting. And what motivated you to create Hawk Capital, and how does it reflect your vision for investing in global AI?
Yeah. So Hauck Capital, like I said, is kind of like our accidental fund. We were meeting with who is now an investor in Legacy Capital and my business partner in Hauck Capital. But my chief investment officer, Heidi Deemer, and I were in Dubai last year in the fall, and we were talking with this guy. His name is Sheikh Khalifa, and he's part of the Al Muadi family. And he told us about an opportunity within the UAE government where they've set aside $100 billion to invest in AI projects and businesses over the next couple of years. And he told us that we should create a fund to capitalize on that opportunity. I have a lot of experience in AI tech and emerging technologies, and so it was a great fit. And so it's something that we jumped on very quickly. We quickly got residency in the UAE, um, and we established our business model over there and started raising capital before the end of last year.
Got it. And Hawk Capital seems like a hybrid fund of funds
Yes.
model, a mix of different investment strategies rolled into one fund. So can you give us an insight into that?
Absolutely. Yeah. We set it up as a fund to fund model because we not only want to be able to invest in AI based practices and emerging technology, but other funds that are doing similar things. We can actually fund up to $50 million of Legacy Capital's business with money from Hawk Capital. And so those two funds can work in tandem with each other. But there's a lot of opportunity out there with not only businesses but funds, and so we decided to build that hybrid model to take advantage of both.
Right. And the growth stage AI space seems to be very crowded with different sort of established investors already playing in that area, right? So, what's your unique edge when competing with top deals against larger, more established funds?
That's a great question. I mean, we're looking at AI businesses that larger funds really aren't taking a look at. Most of them are lower mid market to mid market deals. And a lot of these businesses that we're looking to invest in, they've been around for at least 3 years. They're already profitable, and they've been growing rapidly over the last few years. We're not looking to make full acquisitions of these businesses. We're looking to come in as financial controllers, but operational partners. For instance, one deal we're looking at investing $25 million into the business for 51% of the equity. They already have a great operational team and process in place. We're really just coming in to provide the capital that they need in order to help them go public over the next year or two. And a lot of businesses that we're working with or looking at investing in have given us exclusive rights to invest in their business, on top of other capital that they're currently raising. So not a lot of competitors in the space. Plus, we know what we're looking for from a lower mid market to mid market perspective, and we look for the deals that are have the most upside and most the highest potential for a lucrative exit over the next couple of years.
Absolutely. And in the global AI ecosystem, there are different countries at different stages in their developments in innovation and investments they're making into the technology. What particular areas, maybe outside of the main markets, let's say the US, that you are keenly looking at and tracking?
Yeah, so for Legacy Capital, it's within the U.S. I mean, we're also looking at e-commerce and SaaS-based companies located in primarily English-speaking countries, Australia, certain parts of Europe, England. Um, we've even looked at a company in Singapore that is very profitable. With Hauck Capital, I mean, most of the businesses we're looking at, they don't have to be in the UAE or headquartered in the UAE. They just have to have some sort of tie-in and somehow benefit the UAE GDP and government in some form or fashion.
Absolutely, quite interesting. And uh, how will the AI fund, the Hawk Capital, and the buyout fund, that is Legacy Capital, how will they work in tandem, if at all? What are the synergies between both these funds if they are going to operate at the same time simultaneously?
Yeah, I mean, the fund-to-fund model helps with that. As mentioned before, we can fund up to $50 million of legacy with funds from Hawk Capital. But really they overlap from a technology standpoint. So, if we find an AI legacy business in the US for legacy capital, we'll definitely jump on it. But there's not a lot of those out there. A lot of the businesses are more, legacy businesses that have been around for 10 plus years. And you're not going to find AI businesses that have been around for 10 plus years in the lower mid market in the US. And so from a tech standpoint, yes, there's overlap, and from a fund to fund standpoint, there's some synergies, but for the most part, they're two separate funds.
Got it. Interesting. For founders that are listening, what's the biggest green flag you look for in the team, and what's the common red flag that makes you pass a deal?
That's a great question. I mean, we look at the ability to transition businesses over. So as we come in and we look at a deal, we're working with managers. We're not going to work with management teams that uh, aren't flexible and working with us and understand that we need to come together as a partnership, especially if we're, looking to provide them with equity in the new business and have them help us with transition. So it's got to be a willingness to help the transition and to work well with us. There's got to be a good fit, personality wise and attitude wise, and willingness to work with us. Red flag would be the exact opposite. People that, are really just trying to get the best, um, the most money out of their business. They don't really care about the legacy of their businesses. They don't care about transition. They just want the money and they want to get out. That causes big red flags to us because, why are they hiding something? Because, that they don't want us to see. Is that the reason why they want to get out of this business as soon as possible? Why aren't they willing to transition for at least 6 months with us? Why do they not want equity in the new business? It raises some red flags, and so that's probably the biggest red flag in and of itself.
Yeah, that makes sense. And when you're fundraising from LPs for these funds, uh, what's your pitch about delivering returns and managing risk in the current economic climate?
So both of the funds, they pay out quarterly distributions. So with Legacy Capital, LPs can expect a 92% return on average per year. And they can expect a 5.5x multiple on their invested capital. So if they're investing, the minimum in legacy, which is 250,000, they can expect a return of about $1.4 million over the life of the fund, which is 7 years. And it's similar for Hot Capital. It's a 7-year fund, and they're receiving quarterly distributions. And we manage risk really by looking at the top 5 to 10% of the businesses out there that are for sale. That, like I mentioned, with legacy, the U.S. market's is a very saturated market right now with legacy businesses, and we essentially have our pick of the litter. So we only look at the top 5 to 10% of these businesses. They have to be extremely profitable. There has to be a huge value add and a huge upside. And we get these businesses acquired for very undervalued rates. And so that's how we manage risk. We're not a VC. We're not looking to acquire 25 companies and hope that one of them makes it. We're acquiring 25 very profitable companies that have been around for several years, 5, 10, 15 plus years. Has a great model already, has a great customer base, has a lot of demand in the market. And we may have one of those businesses out of the 25 fail, but we are looking at very profitable businesses, which for LPs is a great thing because they're receiving quarterly distributions from day one.
Right, absolutely. And you're promising a short duration strategy that the businesses are going to exit in 3 to 5 year time frame, and you're going to see exits. LPs are going to see exits in the portfolio, right?
Yes.
Why is that structure attractive to sellers, and what does it unlock for LPs?
Well, it's attractive because I mean, not only are they getting our LPs getting quarterly distributions from the profits of these portfolio companies, but as we're looking at hold periods of 36 to 60 months, we're turning over these businesses pretty quickly. And so from day one post acquisition, we're looking for, ways to build these companies up very rapidly over a short amount of time. And we're already thinking about an exit strategy. So who can we sell this business to? Is it going to be a roll up? Is it going to be a consolidation with another company? What is the overall plan for exit? And when do we think we can exit this business? Because, the faster we can turn over businesses, within that 36 to 60-month hold period, the faster we can provide greater returns to our LPs on top of the quarterly distributions that are already getting from the profits of these companies.
Yeah, totally makes
Yeah.
sense. And after you have made a deal, you have acquired a business. Uh, what happens after that? What's the step by step process by which you run the operations of the business and transform it to run like a well oiled engine?
So the first thing we do even before acquisition is we work on hiring the new management team that'll work with the existing managers, the sellers of the business during transition. So that's very important to find the right people, the right fit, and the right transitional plan for each of the companies that we look to acquire. And that's primarily on the legacy capital side. Within the first 120 days of post acquisition, we're looking at normalizing their data. We're looking at updating their technology and their processes. We're bringing them onto our continuity platform, which is essentially an agency model middleware component. We use MuleSoft, and then we have our own agency model CRM systems and other tech platforms, and so we add them onto our platform, and it really opens up the ability for them to see, return on investment and return on ad spend in real time, what the different aspects of their business that are making the highest returns, and where we can put, the majority of our investment post acquisition to help build these companies up. So we're thinking about, an exit from day one, and we're planning, backwards from that. But really, on top of that, we're looking at onboarding them to the different platforms that we have and building out their tech platforms and their operations.
Absolutely. And what's your mechanism for deal sourcing, and how do you consistently find high quality deals that others don't win before you?
Yeah, for legacy, deal sourcing is definitely not a problem. We have three different ways of sourcing deals. Most of the deals we source are through business brokers throughout the U.S. We have 25 business brokers throughout the U.S. that we have agreements with, and they provide us with um, we essentially have first right of refusal on any of the businesses they send us. We have 24 to 48 hours to pass on a business before it hits the open market. And then we also have an internal team that is sourcing off-market deals for us. And then we have an external team doing the same thing. And so they're finding businesses that fit our model that aren't even thinking about selling their companies at this point in time. And then we hook them and get them into our acquisition pipeline. And we source about 50 to
Yep.
60 business deals per business day with Legacy Capital. And last month alone, we looked at over 1,000 deals and issued LOIs. We have about 18 companies in our pipeline right now that are late stage due diligence, and 4 that we're looking to close on within a matter of weeks.
Got it. Can you give me an insight into what does the internal decision making process look like while you're evaluating these deals and thinking if we should do this deal or pull out?
Sure, we have a few, filter mechanisms in place. And so my team will evaluate the deals as they come in from business brokers and off-market deals. And if it looks like something that fits our model that we want to continue doing due diligence on, the team will issue an LOI. And then from there, we'll get into, more serious due diligence. We have a team with Acuity that handles all of our front office and due diligence. From there, they'll walk through, they'll go through the 160-point due diligence checklist that we have in place for all of the businesses. And it's really pretty standard stuff, looking at whether or not they have any lawsuits in place or unresolved liens on their business or anything like that. Looking at the management teams, looking at the formation of the companies, the structures, everything holistically on top of the financial history and performance of the company. But yeah, we have a few filters in place. It starts with the lead coming in, and we look at that lead, and then it eventually will turn into, an LOI, an accepted LOI, and then we turn it over to our due diligence team to manage it from there. And if as it gets closer, then I step in with my team, and we focus on purchase and transaction details of the deal.
Got it. Interesting. And you've been an operator before and you've seen multiple exits there,
Yes.
right? How does that experience shape the way you evaluate risk and build conviction on deals?
I mean, with working on over 150 businesses and clients, most recently as an agency partner at a small digital marketing agency, um, and working on clients like Qualtrics, I've seen firsthand what it takes, from a financial perspective and from an operational perspective to build a company up. And I know what the blueprint of those companies looks like, as before we even begin the due diligence process with them. And so it's really just looking at those companies and those organizations from, you know, through the lens of my experience, and teaching my team how to do the same thing.
That's quite interesting. And coming to my last main question before we go to the rapid fire round, and this is what would be your boldest prediction when it comes to the future of technology, AI, or transportation, maybe in the next 5 to 10 years?
Well, I mean, our growth projections and the growth projections that we're seeing, throughout the world are big. And so, I mean, what would be great is over the next few years, we see those growth projections come true. We exceed those growth projections. And the businesses that we've acquired or that we have investment stakes in have become even more valuable because of what's happening throughout the world and in these particular sectors.
Yeah, quite interesting. And now moving to the rapid fire
Sure.
round, and I'll ask you six quick
Okay.
questions about the investment you are doing, and you can answer for both the different funds that you're running, right? So the first one is, what are the sectors and regions you invest in?
So legacy capital, it's transportation and technology. And as I mentioned before, SaaS, e-commerce, health tech, fintech, transportation technology, freight, and 3PLs. And with Hauck Capital, it's AI and emerging tech. We also look at defense platforms, um, cybersecurity, and data centers.
Got it. And with Hawk, you're also investing into funds. Is it?
Yes, exactly.
That is okay. So what's the typical stage of investment?
So with legacy capital, the business needs to be very profitable. They need to be selling for a multiple under 5x EBITDA to revenue. They need to have low debt under two, as a debt to revenue ratio. They need to have a very valuable product and service, and it's got to be something that has a lot of upside. And the business owners need to be willing to help us transition the business over the next 6 months to a year. With Hot Capital, we look at AI and emerging tech companies that have been around for at least 3 years, are profitable and are growing rapidly, and really just need the financial support to, for a lucrative exit over the next few years.
Got it. Do you lead rounds? So buyout, of course, you lead that round, but you can also for Hawk Capital.
Yes, so we will invest enough capital to acquire upwards of 75% of the business and take financial control. We'll take anywhere from 25 to 75%, but the goal is to have financial control of the businesses that we invest in, and then leverage, the existing teams as operational partners.
Got it. And for Hawk Capital?
Yeah, that is for Hauck Capital.
Oh, okay. So for Hawk Capital as well, you have to acquire businesses. Is it
Well,
in that too?
it's we're investing in businesses. So we're coming in as financial managers, but then we're working with them as operational partners. And we're not taking full control. We'll go up to 75%. Most of the deals we're looking at are between 25 and 55%. But
Mhm.
then they already have strong operational teams in place, and we come in with financial support to help lift those businesses up.
Got it. What's the typical check size you put in?
So check size, I mean, minimum with legacy is 250,000. We've been seeing, an average check size of about 750,000, primarily from independent accredited investors and family offices. With Hauck Capital, it's much larger. We're looking at investments, typically that range anywhere from $1 to $3 million minimum. But an average check size there is really about 5 million.
Got it. Where can founders get in touch?
Founders, they can get in touch with me. They can reach out to me at scott@legacycap.pro or scott@hawkcap.pro. They can reach out through the websites. For Legacy Capital, it's legacycap.pro. We're still finishing up some revisions on the Hauck Capital website, and we should have that released again here in the next couple of weeks.
Awesome. Last one. Where can our listeners follow you?
Follow me on Instagram. We have Instagram pages for both Legacy Capital and Hauck Capital. Sign up for our weekly newsletter. We'll send out articles that have a lot of value, that provide a lot of valuable information on what we're doing within the PE space and within the financial space. And so follow me there as well.
Yeah. Yeah, that's interesting. This is the first time someone has said Instagram and not LinkedIn, so I'm happy.
Yeah, LinkedIn, you can
It's
follow
mostly
us there
LinkedIn.
too. We do post things on LinkedIn, but I mean it's mostly Instagram, and then we have a weekly newsletter that we send out, and so
Yeah.
that's the most popular places for people to follow us.
Yeah. Awesome. I'll make sure to put those links in the show notes below so our listeners can get there easily. Thanks so much for doing this with us, Scott, and I wish you all the best and happy investing.
Thank you so much, and thank you for the time. It's been an honor.
Likewise. Thank you.
Thank you.